Hi, I'm Michael Joyce from Agili, and I'm pleased to share with you our thoughts and viewpoints for the fall of 2018. And I'm going to start today by taking you back 20 years ago to 1998. In 1998, the economy was also doing really well, and that was driven by a lot of technological innovation. If you remember back that far, we had this newfangled thing called the cell phone that was the size of a brick and really only worked well in major metropolitan areas. We had the internet that we could access through dial-up modems, and sometimes the pages went by really slow. And we had social media, which was then the gossip pages of the print newspaper. But if you had invested in the stock market in 1998, over the last 20 years, you would have had a 7.4% annualized return. Now remember, during those 20 years, we had two very scary bear markets where the U.S. stock market went down by over 50% in 2000 to 2003, and again over 50% from 2007 to 2009. And other asset classes have done well, but if you put all your money in the stock market, you basically would have quadrupled your money, assuming you didn't take anything out in the interim. Now, how much do you think the average investor has made over those 20 years? Well, there's been some recent studies by JP Morgan and Vanguard that have shown that the average investor has made 2.6% annualized return over 20 years, barely beating inflation over that period. So how do you explain that? Well, it can be explained by human nature. Most people want to invest their financial assets to meet their long-term goals and objectives. But we're impacted by our short-term emotions. We're, the things that we're seeing currently in the media, the things that we talk about with other people. So a lot of people, they buy the hot stock when it's at its high, they sell when stocks fall, and they don't buy back in when prices are still low. One of our goals is to be financial stewards for our clients' long-term goals and objectives. And to do that, we want to take into account everybody's long-term goals and objectives, their risk tolerance, their time horizon, and build a personalized and customized portfolio around that. So far in 2018, returns have been kind of pedestrian. We had great years in 2016 and 2017, and the economy is still going great. And it's not just the US economy, it's the global economy. But we are being buffeted by headwinds, and one of them is something that we refer to as the 3 T's: trade, tariffs, and tweets. And with tariffs, basically tariffs are a tax, and they're going to increase the price of consumer goods. And if that happens, we're going to have some higher inflation, and we could have higher interest rates. And if we have higher interest rates, that means that price-earnings ratios on stocks will have to come down, and other asset classes like long-term bonds and real estate also won't do well. And as we move into the fall, there's also some financial planning things that you really should be thinking about. We're right around the corner from open enrollment period. So people are going to get their enrollment for employee benefits for the coming year. And I can pretty much assure you that in terms of health insurance, you're going to see premiums that are going to have increases that are more than the rate of inflation. In some cases, substantially more than the rate of inflation. So I'd encourage you to contact your financial strategist at Agili and talk through the employee benefits package from your employer before you make some of those decisions during the open enrollment period. This is also the time of year to think about any charitable contributions that you're going to do before the end of the year. Because of the new tax law has doubled the standard deduction, a lot of people aren't going to be able to take charitable deductions on their tax returns anymore. But there are still some ways for people that are charitably inclined to make the best use of this. For example, if you're over age 70 and a half, the best thing to do would be to take qualified charitable distributions from your IRA. And what that will allow you to do is to meet some of the responsibilities of your required minimum distribution, but whatever goes to charity will be non-taxable. If you're under the age of 70 and a half, we've had a period where a lot of assets have appreciated substantially. So you can contribute appreciated securities still. And really, you should be looking at doing that not in the last 2 weeks of the year, but as we get to the end of November or the beginning of December. I also want to talk about required minimum distributions. Again, people over the age of 70 and a half have to make required minimum distributions. And again, this is something that shouldn't wait until the last 2 weeks of December, because IRA custodians really get jammed up during that period. Again, right around the beginning of December, look to knock that out. So I've been really happy to share with you our thoughts and viewpoints for the fall of 2018. If you have any questions, feel free to contact your financial strategist or to contact me. You can also follow us on our website, agilipersonalcfo.com, or follow us on Twitter. Thanks, and have a great day.